I'm Charlotte McLeod with the Investing News Network, and here today with me is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Thank you so much for joining me online today. Great to see you as always.
Great to see you too, Charlotte. Thanks for having me back.
Of course, and we have a lot to talk about as usual. I think where we should start with is the stock market losses that we've seen in the last little while. I think moves like that can be a little bit alarming for many investors. So I want to ask you what you see going on there and perhaps how you've been able to hopefully turn that situation to your advantage.
Yeah, so you're absolutely right. I mean, so we're seeing some big time moves, the NASDAQ 100 having days where it's up or down 2 to 3%, which is somewhat abnormal for sure, especially what we're used to over the last few years. So really what's going on here is that you now have a Fed that's tightening, and we know that. And next week, we'll see probably a 50 basis point rate hike. The market is now pricing in further rate hikes the rest of the year and a potential slowdown in the economy because of that. Now, the market was kind of just getting normalized to that thought process. And then we saw Netflix earnings last week come out. And that really shocked the market because, again, a stock like that, the size of Netflix, to fall 37 or 38% in a day is really abnormal. I mean, that's a shock to almost any investors. And what you have is, as the market gets closer to the earnings today from or from Microsoft and from Facebook and from Google and from Amazon and Apple later this week, all of these things are now making investors worry. What if they drop 35%? Now, Apple's not going to drop 35%, but even a 10% drop in Apple could be very, very hurtful to the overall market, considering these are trillion-dollar companies. So I think the investing public is getting very wary now after they saw these massive drops. And it does, I mean, we are seeing it drop quite a bit. For me personally, it's a trader's market. So again, I look for little place here and there. I'm very, very nimble, or trying to be, because it is a market that you can get seriously hurt in if you do the wrong thing at the wrong time.
Right. And as you mentioned, looking forward to the Fed meeting next week, that seems to have been one of the many things that has people feeling a little bit concerned. We seem to be looking at a 50 basis point hike next week. I wondered if you could go over your expectations for that meeting. Are there any other elements that you will be keeping an eye on as we move toward that?
Yeah, so I think the big thing going into next week is how do these earnings shape up? Because if we see a lot of these big earnings come out and the stock market drops, let's say 5 or 6% by the time we get into this Fed meeting next week, you may see, I mean, I think it's a foregone conclusion you're going to see 50 basis points, but you may see a slightly less hawkish dove. Or less hawkish Federal Reserve commentary. And that'll be something that I watch for in this meeting, is basically how is the market acting going into the meeting? And then what does the Federal Reserve say based on that? I think if the markets rally on the back of these earnings, then the Fed is getting more clear signals that they can be more kind of hawkish and raise interest rates. So it's really about how this market trades. And I know the Fed likes to say, oh, I don't pay attention. They don't pay attention to the stock market. But in reality, the stock market is the economy. When the stock market was roaring over the last few years after the COVID drop, we know that people had more money, then they spent more, and it stimulated the economy. If the stock market drops, I mean, I think the NASDAQ right now is down like 22, 23% off of the highs. If you're down 30, 40% at some point, there's going to be a major slowdown just because of that, based on the drop in the market. So we have to kind of keep that in mind. And that's what I'll be looking for in the Fed decision.
Right. And so we know that, Gareth, you're very agile when you're making your trades. You are in and out. You're watching the markets every day. Maybe you could give us an idea of what you're doing, but also, for investors who may not want to be in and out all the time, how can they handle this situation where we're watching a lot of things moving towards some big decisions here?
Yeah. So for people that are just kind of monitoring this market and getting nervous, I mean, remember, cash is a position. And I know no one wants to be in cash with inflation high, but it actually can be a good thing because you can wait patiently for stocks to bottom out. Now, when you're looking to buy investments, right, I would strongly encourage quality names, right? Go to the quality names after they've been hammered. So for instance, for me, I like companies, honestly, like a Netflix here. And in fact, we can look at Facebook and Netflix, but these are two quality names. Facebook is not going anywhere. The ad revenue should be monstrous. You can see it's down at this range, down over 50% from its highs. I have this upsloping trend line just a little bit lower. So, if this were to get down here, I mean, even here at the current levels of 180 is kind of interesting going into earnings, but down here at 165 is also an interesting level. And the reason why I like these is, number one, it's best of breed. So Facebook is best of breed, and it's still a cash cow. I mean, even with things slowing down, people going out because of COVID now, not on Facebook as much, it's still the number one play, and it's discounted massively from where it was. In fact, it's trading back where it was in late 2017 and 2018. So I like those type of names. And then if you look at like a Netflix, everyone's kind of blasting Netflix and saying, oh, it's over. But in reality, Netflix is down from $700 to $200, and it's trading back at levels that it hasn't seen since 2017. And to me, I look at it and say, well, listen, yes, things were going to slow down after COVID because people don't want to be cooped up in their houses anymore, but they're going to see stabilization. They're going to fix a lot of these issues. And when companies are down this much, expectations are rock bottom. So it doesn't take a lot for them to come out and say, hey, we're going to do this one tweak. And all of a sudden the stock can rally 10 or 15 or 20%. So again, I think it's important to start nibbling. Don't go all in, but these are definitely names, go towards the best of breed that have been crushed and looking for a snapback bounce at some point.
Okay. Really interesting points there. Thank you for that. And so you mentioned inflation. I want to check in with you about inflation. We do have the Fed finally now seeming to be taking a stand against it, but we know that no matter what they do, it won't be an immediate reaction. So for you, when you look at the outlook, how long are we going to be living with inflation?
So, and if we look at inflation and the gauge of inflation, meaning, 2% or sub 2%, which is what we were living with prior to the last year and a half, my guess is 5 to 10 years. And I know that's scary and I know that's horrible, but there's no way that the Fed can put that genie back in the bottle when you have wages going up as much as they are, right? So if you think about the way a company works is, all of a sudden they have to hire people at, $25 an hour that they were paying $15 an hour. They can't all of a sudden turn around and raise the price of a widget and double that to offset the rise in cost. So they're going to do it over a course of many years where they're going to raise prices, let's say 10% per year. And that's going to keep inflation relatively high. Now, having said that, I don't think we're going to get, it's not going to be like we're going to have 10% inflation every single year for 10 years. I think more so it's going to be 8 to 10% for a year to 2 years. Then it's going to start coming down to 5% and kind of get sticky at around 5%. And the problem with that for the Fed is that it's still too high for the Fed to print a lot of money. So this is my biggest concern about what could happen is that if the economy starts to really stutter and starts to, trip and get into a recession, and you still have inflation, let's say at 5 or 6%, how does the Fed come out and print, trillions of dollars again with inflation at those levels? And I don't think they can. And so it really puts them in a bind about, okay, well, what can they do? Yes, they're raising interest rates so they can lower those interest rates. But again, the printing of money has really been what's gotten us out of these recessions or these downshifts in the past. And that's going to be really tough. And it's not going to be pretty, I fear.
Right. And you told us last time there's a real risk of a recession. We're starting to hear some people throw around terms like depression. Would you go so far as to say that's a possibility here?
Not in the near term. So you still have a consumer that still has a lot of money out there because of COVID and savings. In fact, some of the metrics show that they've actually put away quite a bit. So it's going to take some time to go through that. But I do think when you're talking 5 to 10 years out, yes, I think it'll be something where the Fed will get this inflation bug under wraps down to 5%, maybe a little bit below. Then we'll hit a recession. Then they'll do whatever they can do to stimulate it. And it'll kind of keep us afloat, kind of like a dead man walking type thing where we're still kind of trudging along. It's just not a robust recovery. And then that's where, 3, 5, 6 years down the road, where I think you really start to worry about, okay, what happens when the next dip comes? So I think that's where I'm kind of positioned. I'm almost looking at the cycle, the 100-year cycle. So we know that COVID coincided about the 100-year cycle of the Spanish flu. And then you also think about the Great Depression, 1929. And if you look out 5, 7, 10 years out, that kind of puts us right around that 100-year cycle for potentially a depression.
Okay, and so we're always looking at what is our audience searching for, and something that's come up lately a lot is like inflation-proof stocks, recession-proof stocks. For you, is that a real thing, or those things that you would like? Can people find that kind of thing out there? How would you address that?
Yeah, so I think, for instance, for me to protect myself in gold, gold is always a place to go, right? We know gold broke out recently. Now it's having a retrace, which is very, very normal for the chart. I expect another big leg up in that. That's a great way to kind of protect yourself at least a little bit. I think there are certain stocks where you can offset inflation a little bit, but my big worry about that is that, like let's say IBM, which pays a good dividend, or AT&T that pays a really good dividend. Number one, the dividend's not going to equal 8 to 10%. Number two, if the stock, because the stock market's tanking, still goes down, you may end up breaking even or even losing on that anyways. So I think people have to be real careful here. I think the metals are really the best place to be for the hedge for inflation. And then again, if you want to dabble in some of these beaten down names for shorter term bounces like a Facebook and a Netflix, I know there's a lot of risk in those, but at some point they're going to get these big snapback bounces. Now, don't misunderstand what I'm saying is, you're not going to go into Netflix and say, hey, I expect it to go back to $700. Can Netflix go from 200 to 230 and make 10, 15%? Yes. I do think that's a very logical thing when the stock market bounces. So if you're nimble and you buy best of breed companies, I think in this market environment, you can hang in there and at least offset that inflationary pressure.
Okay, so let's now check in on gold. We always like to see what's going on there. As you were just mentioning, it's covered a pretty big range in the last week or so. We were almost up at 2000. I believe now as we're talking, it's more like 1900.
Yeah.
So what are you seeing there? Do you see support at this 1900 level?
Yeah, so support, there is a little bit of minor support at 1900 here, and I'll put a trend line on. So we can see these little low pivots right here. If we draw a trend line right there, it kind of meshes right with that level. My fear is that I do think you still have a little bit more downside in gold. I think that this level will give way, but this is going to be like the best buying opportunity. So if you were someone, and again, before we broke out, so you can see this clear breakout that occurred back in February. If you didn't want to buy it before the breakout and then it ran up too much before you to chase it, you're going to get another opportunity. Likely, you're going to see a move back to like 1850 to 1825. And I think that is your spot. That is your spot where it's a retrace to the breakout trend line. You also have this kind of area right in here, right around 1850. And yes, I do think this is going to go much higher. I've talked about comparing the time frame that we're into the 1970s and the movement in gold there, where it went from $100 an ounce to $900 an ounce. And I think that is your great opportunity. So for me, I'm looking to accumulate more when it comes back to 1850 to 1825.
Yeah, and we have gone over your long-term expectations for gold. It's good to know that that is still solid. I wondered if we could take a look at the commodities sector as a whole, taking a step back. I think one headline I saw today was the World Bank saying we should expect high prices for commodities through to 2024. I wondered if that's something that you're seeing in the charts as well, if we look at that massive sector of commodities.
Yeah, so I do think that is generally true. I think we have to be aware that, certain metals are used in manufacturing and industrial, ways. So I think it's not as simple to just say, oh, all metals are equal, right? So you have the gold, which is a perfect inflation hedge that should do very, very well. Generally, it's not ridiculously volatile. Then you have silver, which is partially industrial, partially a store of safety. That's obviously more volatile, both on the upside and the downside. And then you have things like platinum, palladium as well. So I think again, the gold is the pure play, but I do advise. I would definitely suggest being diversified with some of those other metals as well, and kind of diversifying out within the range, just so you're not all in. You never want to be all in on any one thing. Generally, I say, never more than 10% of your portfolio in any one position, and I think that's very, very true, even when you look at the metals.
Right. And if you were going to diversify in the metals, say beyond gold and silver, where would you be looking?
Yeah, so I do think that platinum, palladium, platinum, interesting enough, and I'll show the chart here. Let me just bring it up. But platinum has actually been hammered quite a bit recently. And let's jump into that chart. So we can see platinum's come way back in here. And let me just zoom out a little bit. So we can see, again, platinum all the way down here. There's a lot of support just above 900. And if it gets below 900, there's more support around 850. So, anywhere between 850 and 900, I think makes a lot of sense. If you look at the chart here and we put in a trend line, The trend line I'm watching for now is this one right here. And in tune with that, you kind of have a parallel line right down here. So notice the 900 to the 850 level is kind of right on top of this trend line down here. And again, you're trading in this sideways consolidation pattern. Now, this pattern from this low up here and this consolidation is a bull flag or in spirit of bull flag pattern. So, buy it kind of in the lower range. And then I would expect at some point for it to at least test the high end, maybe even break out to the upside. I also think, keep an eye. I don't think uranium, let me look at URNM here. I don't think uranium's quite ready to be bought yet, but I do think that if it comes down in this range, this $50 level on the uranium miners ETF, I do think that that gets interesting there as well. So there are some opportunities. And again, diversification, I think, is the best way to go about it, just so that you kind of hedge your bets. You never again want to be all in on anything.
Of course, of course. So now that we've taken a look at what's going on in the metals, we should move over to Bitcoin. We always check in with you on this. And you've been telling us for quite a while you expect a big fall down to 20,000 or perhaps even lower. So I know that every time we post an interview, people are asking, well, it's not there yet. When's it going to happen? So let's look at the chart if we could, where we're going. Maybe you could talk about why you're expecting that decline, especially because I know in the long term you are bullish on Bitcoin.
Yeah, so I think today's price action in Bitcoin is just everything to me, right? So yesterday, Bitcoin was trading below this trend line. The NASDAQ futures were getting clobbered. And then the stock market opened, and all of a sudden we saw the NASDAQ starting to rip higher. What ended up happening, Bitcoin followed the NASDAQ, the tech stocks, as a risk on trade, and it rallied all the way back up here. Now today, the NASDAQ's getting smoked again. And guess where Bitcoin is? It's going right back down. So if you're asking why Bitcoin will eventually go to 20,000 or sub 20,000, honestly, it's basically a stock market call. It's a liquidity call. So the Fed is tightening. They're pulling liquidity out of the system. They're not printing and pushing and pumping money in. And so you're going to see this kind of deflation of the bubble in all asset classes. And especially when you're looking at tech and cryptocurrency, they were the recipients of the most infusion of capital. So they're going to see the most exodus of capital. So the bottom line is the chart here has a classic bearish pattern to it. At some point, it's going to break this trend line, probably head down to that 29 to 30,000 level. I think that, again, the tech stocks have at least another 20% downside over the next 6 to 12 months. So you're looking at if tech goes down that much, let's say if the NASDAQ 100 drops that much, Bitcoin probably sees 40% downside, which then puts it kind of close to that or around that 20,000 marker at this point. I also think you have to recognize that the .com bubble in crypto is bursting now, right? We saw this, the same pattern, this M pattern on the chart is the exact way, the exact pattern that Amazon had in 2000 before it went from $112 to $6. Obviously, then it went to 3,800. So, I mean, there is light at the end of the tunnel. I'm bullish on it longer term. But again, think about it like this, is that crypto, everyone was crazy about it or is crazy about it. It's a changing the world technology. Blockchain is changing everything. The same thing was true about the .coms and the internet. It didn't stop the bubble from bursting. So you have to see this flush out. I think there's over 19,000, cryptocurrencies at this point. You can't see 19,000 cryptocurrencies. You need to see a flush out. You have to get rid of the dead wood, if you will. And then the best of breed, the Bitcoins can finally start to make a move up that is sustainable. They'll get more acceptance at that point by more and more investors, and you should see much higher highs at that point. But I still think you're going down lower, unfortunately, for Bitcoin and crypto holders.
Okay, I think that was a really good reminder. As we're wrapping up here, usually I find that you can find a silver lining in most things, whether it's playing the ups or downs in a market. So I want to finish up by asking, is there anything that you are not touching right now, things that you are staying away from in the market at the moment?
Oh, that's a great question. The answer to that is no. It's all based on price, right? So you could show me a stock that's $100 and I may not want to touch it, but if it fell in the next few days on market sell-offs to $50, I might be enticed for a bounce back to 60. So as a trader and a swing trader, I'm a much shorter term investor where I look for these type of things. I think if you have a longer term view, the best place to be is just in cash right now, or just on the sidelines in some metals, maybe jumping in occasionally with very small positions in the best of breed names. But for me, yeah, I mean, it's like an addiction, right? You see a great opportunity. I can't say no to it. Obviously, you go in small. I always invest small because you never know if it's going to go against you. But for the most part, if you learn the charts, you can definitely do well in this market.
Okay, for sure. Well, thank you for that. I think that's everything for me. Always great to hear from you.
Thank you so much, Charlotte. Have a wonderful day.
Of course, you too. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Gareth Soloway with InTheMoneyStocks.com.